Hi traders, and welcome to another video. In this video we will talk about how candlesticks represent price and how we can use them to our advantage. Candlestick charts have been developed in the 18th century by Munhisa Homa, a Japanese rice trader. Candlestick charts are a visual representation of a financial chart. Candlesticks often serve as a cornerstone of technical analysis and help traders with their decision making. A candlestick chart is a style of a financial chart used to describe price movements. Traders can identify price action of any given time frame. The anatomy of a candlestick. Okay, so Japanese candlesticks can be used for any time frame, whether it be 1 day, 1 hour, 30 minutes, 5 minutes, whatever you want. They can have any color you want them to be, but typically bull candles are green or white and bear candles are red or black. Bulls are the buyers and bears are the sellers. Bulls and bears are always in a fight. The candlesticks show us who won in any specific period of time. Long green or white Japanese candlesticks show strong buying pressure. The longer the green or white candlestick, the further the close is above the open. This indicates that prices increased considerably from open to close, and buyers were aggressive. In other words, the bulls were kicking the bears' butts. Long red or black candlesticks show strong selling pressure. The longer the red or black Japanese candlestick, the further the close is below the open. This indicates that prices fell a great deal from the open and sellers were aggressive. In other words, the bears were winning the fight. The upper and lower shadows on Japanese candlesticks provide important clues about the trading session. Upper shadows signify the session high and lower shadows signify the session low. Candlesticks with long shadows show that trading action occurred well past the open and close. Japanese candlesticks with short shadows indicate that most of the trading action was confined near the open and close. If a Japanese candlestick has a long upper shadow and a short lower shadow, it means that buyers flexed their muscles and bid prices higher. But for one reason or another, sellers came in and drove prices back down at the end of the session, back near its opening price. This goes the other way around as well. When a candlestick has a long lower shadow, this means that sellers were pushing price back down, but the buyers managed to kick their butts and drove price back up. Candlestick patterns. Before moving on to bullish or bearish types of reversal candles, let's take a minute to look at the neutral candlestick patterns, or in other words, indecisive candles. The most common ones are doji candles and spinning tops. The super small body shows little movement from open to close, and the shadows indicate that both buyers and sellers were fighting but nobody could gain the upper hand. Neither buyers nor sellers could determine direction, and as a result there was a standoff. If a spinning top forms during an uptrend, it usually means there aren't many buyers left and a possible reversal in direction could occur. If it forms during a downtrend, it usually means there aren't many sellers left and a possible reversal in direction could occur here as well. Be careful if you want to trade these. Only use them as an extra confirmation at a price level you are already looking to buy or sell the market. Some traders also use them as a signal to exit. Hammer and hanging man. The hammer and hanging man look exactly alike but have totally different meanings depending on past price action. Both have small bodies, bullish and bearish, long lower shadows and a short or even absent upper shadow. The hammer is a bullish reversal pattern that forms during a downtrend. It is named because the market is hammering out a bottom. When the price is falling, hammers signal that the bottom is near and that the price can start rising again. The long lower shadow indicates that sellers pushed price lower, but buyers were able to overcome the selling pressure and closed near the open. Just because you see a hammer form in a downtrend doesn't mean you automatically place a buy order. More bullish confirmation is needed before it's safe to pull the trigger. The hanging man is a bearish reversal pattern that can also mark a top or a strong resistance level. When the price is rising, the formation of a hanging man indicates that sellers are beginning to outnumber the buyers. The long lower shadow shows that sellers pushed price lower during the session. Buyers were able to push price back up some, but only near the open. This should set off some alarms, since this tells us that there are no buyers left to provide the necessary momentum to keep raising the price. Inverted hammer and shooting star. The inverted hammer and shooting star also look identical. The only difference between them is whether you're in a downtrend or an uptrend. An inverted hammer is a bullish reversal candlestick. A shooting star is a bearish reversal candlestick. Both candlesticks have small bodies, long upper shadows, and small or even absent lower shadows. The inverted hammer occurs when the price has been falling, suggesting the possibility of a reversal. Its long upper shadow shows that buyers tried to bid price higher. However, the sellers saw what the buyers were doing and said, "Oh heck no," and attempted to push the price back down. But not enough to have a bearish candle, indicating that most sellers could have left the market and bulls might start taking over again. The shooting star is a bearish reversal candle that almost looks identical to the inverted hammer, but occurs when price has been rising. Its shape indicates that price opened at its low, rallied up, but pulled back to the bottom. This means that buyers attempted to push price up, but sellers came in and overpowered them. This is a definite bearish sign, since there are no more buyers left because they've all been overpowered. Engulfing candles. There are two types of engulfing candles: bullish engulfing and bearish engulfing. The bullish engulfing pattern is a two candlestick reversal pattern that signals a strong move up may happen. This happens when a bearish candle is immediately followed by a larger bullish candle. This second candle engulfs the bearish candle. This means that buyers are flexing their muscles and there could be a strong move up after a recent downtrend or a period of consolidation. On the other hand, the bearish engulfing pattern is the opposite of a bullish pattern. This type of candlestick occurs when the bullish candle is immediately followed by a bearish candle that completely engulfs it. This means that the sellers are overpowering the buyers and that a strong move down could happen. Tweezer bottoms and tops. This type of candlestick pattern is usually spotted after an extended uptrend or downtrend, indicating that a reversal will occur soon. There are two types of tweezer patterns, the tweezer bottom and the tweezer top. Notice how the candlestick formation looks just like a pair of tweezers. The most effective tweezers have the following characteristics. The first candlestick is the same as the overall trend. If the price is moving up, then the first candle should be bullish. The second candlestick is the opposite of the overall trend. If the price is moving up, then the second candle should be bearish. The shadows of the candlesticks should be equal or near equal in length. Tweezer tops should have the same highs, while tweezer bottoms should have the same lows. Pretty simple, right? So what are some of the key takeaways? Candlesticks are practically useless on their own, and you must always consider the market environment and what the market is telling you. So what are some of the conclusions? As with any technical indicator or tool, if candlesticks point to a reversal or a continuation, that does not mean it will happen. Yes, it increases your chances, but it does not make it certain. This is the financial market, and nothing is set in stone. Remember, trading is all about finding confirmations to increase the probability that something will happen. Finding a candlestick pattern is just another confirmation to your checklist, but they can be really helpful. By simply pairing candlestick formations with key levels or with any other confirmation that we will teach you, you will drastically increase your odds for winning. A lot of the time, markets are noisy. Not every candlestick is useful when thinking about future price movements. Also, make sure to wait until the candlestick closes and is fully formed before acting on them. This is a mistake a lot of traders make. They see a candle going up and they say, okay, the market is bullish, I'm gonna buy this. But before the candle is closed, it pulled back and is bearish, and now they are trapped. We've covered a lot about Japanese candlesticks. Hopefully you've paid attention, because these will become one of your closest friends on your road to being a professional trader. Also, we want to say, these were just a handful of all the existing candlestick patterns. You can find a lot of candlestick cheat sheets all over the internet if you want to learn all of them, or ask in the community and we will provide you with them. Thank you for watching, and we'll see you in the next video. Bye.